Have you ever seen someone on TV or heard on the radio who is doing the interviewing, but you'd rather hear that person interviewed? Well, this week you are in for a treat because we're bringing on a guest who I'm sure you've seen either on Bloomberg TV or you've listened to his own podcast, Masters in Business, or you've read his daily blog about what to read. Today, we turn the tables and interview Barry Ridholtz. Welcome to CFTC Talks. I'm your host, Andy Bush. Please subscribe to the podcast by going to iTunes and searching for CFTC Talks. Or you can listen to the podcast by going on our website, cftc.gov, and click on the podcast button. Just a quick reminder, there's a disclaimer at the end of the show that's important for you to hear. For today's show, we turn to a man who's been called one of the 25 most dangerous people in financial media. That's quite a title. Wish I had that title. Barry Ridholtz is the founder and chief investment officer of Ridholtz Wealth Management, a financial planning and asset management firm. Ridholtz is a frequent commentator on many financial topics. He was named one of the 15 most important economic journalists in the United States. He writes a daily column for Bloomberg View and a twice-monthly column on personal finance and investing for the Washington Post. He was also the author of the popular Apprenticed Investor columns at TheStreet.com, and he blogs at The Big Picture at Ridholtz.com. Barry, welcome to CFTC Talks.
Thanks for having me, Andy.
Hey, before we get to your views on the markets, I want to go back in time to the 1980s in your career. You originally got your law degree before switching over into investing in finance. Barry, what caused you to switch and what did you take away from that experience?
So I actually really loved law school. I found it very intellectually challenging. There was a certain rigor and a certain inherent internal logic that made a lot of sense. And then you get out into the real world and you start practicing, and it's messy and it's a lot of boring details and all sorts of I don't want to call it wasted time, but gee, it really seems like you're spending a lot of energy and effort doing things that didn't feel like they were very significant. And I had a friend who was running what was then the predecessor office to what eventually became E-Trade, and he knew I was interested in finance and technology, and I was pretty good with numbers, and effectively said, hey, why don't you join us as a trader? And I very quickly fell in love with trading, perhaps a little too much. Well, that's always troubling, right? When you fall in love with trading too much. But I want to let me switch gears. That's great. I mean, that's interesting. I just wonder, I'm so glad that you found your way with it. And I guess that's the takeaway, right? You know, if you get into something that is not what you thought it was going to be, it's always great to make sure that you make that switch. That's right. And what I found fascinating about trading was that I would be sitting on this loan trading desk, and the person on my left was making a ton of money that month, and the person on my right was consistently getting killed. And then the next month, their roles would reverse. And it really, coming from a different background than the traditional business/MBA background, which half the trading desk was,
right.
I was kind of curious as to, law is rigorous and logical, and there's a very, very specific syllogism that law teaches you. Here are the facts. Here's the governing fill-in-the-blank law, rule, constitution, or trading rule, and then you apply one to the other, and here's your outcome. So that approach, that rigorous approach, when you apply it to trading, actually leads to more questions than it answers. And so when I have two people that appear to be doing the exact same thing, one successfully, the other unsuccessfully, and then the next month those roles reversed, it really made me step back and think, what is the variable, what is the factor here that's changing? And you ultimately discover that it's the human behavior and the psychology of people who, like a baseball player in a slump, when your mind gets in the way. And all investors and traders suffer from that in various degrees. When their mind gets in the way, it becomes problematic. And that sent me down a 30-year rabbit hole of behavioral economics and neurofinance. And, it's kind of become de rigueur today, but I had started reading about that in the 90s before it had become as well accepted as it is today. And I think that really saved me ungodly amounts of money, because you quickly learn that, I'm not as logical or rational or unemotional as I've fooled myself into believing. And then once you start looking at cognitive errors and psychological quirks and behavioral problems, suddenly you discover, I'm not as good as I think I am. I'm wildly over-optimistic. I trade excessively. And I love anytime I'm speaking in front of a room to ask everybody in the room, how many people in here are above average drivers? And invariably, 75, 80% of the hands go up. It's fascinating, which leads to a very, very different perspective on markets and the economy.
Yeah, and I think that's great. And certainly when we see that a Nobel Peace Prize is awarded to Richard Thaler from my alma mater, University of Chicago, on behavioral economics, it's come full circle, right?
It's Thaler, it's Schiller, it's Kahneman. It's been a full run of people winning Nobels Kahneman as a psychologist winning a Nobel Prize in economics is really fascinating.
Cool. Yeah, isn't that cool? I love it. I'm a big fan. I've read a ton of stuff that he's written. And I think that's great. Well, let me jump us to the here and now, and I think an obvious place to start talking about the markets is virtual currencies. From ICOs to Bitcoin to DLT, there's a lot going on in this space, and clearly there's a lot of discussion about bubbles and mania here, because as Bitcoin continues to rise, that's where many of us in the marketplace are looking at and seeing, okay, is this an issue? But what's your big picture view here, Barry?
So there's two really interesting things, and I think you have to separate the two. The first is the underlying blockchain technology.
Right.
And that's a fascinating development, which, if implemented, or perhaps I should say when implemented, by banks and credit card companies and other financial institutions, promise to reduce fraud and improve accountability and allow us to track a series of transactions in ways that we're very dependent upon paper and computers today. And to give you an example of how significant that is, think back to the financial crisis when mortgages had been securitized and then re-securitized and then re-securitized, and when there were some foreclosures after defaults, people were actually showing up at the courthouse and saying, you don't own my mortgage. They own my mortgage. That's who I've been paying my bills to. You're, not the appropriate party to be doing this to. We literally had cases where the chain of title had been lost. And you could go back to the UK in the 9th and 10th century, and they have successfully tracked ownership of real estate for 10 centuries. It took the MERS, the electronic mortgage setup that's designed to track all this. It took them 3 years to lose track of literally hundreds, if not thousands, of proper title, and something like blockchain would avoid that sort of mistake. Now, blockchain is the technology. The various ICOs, the various Bitcoin variations, that's a very different challenge, because it's hard to come up with a valuation for something it's not quite a currency, it's not quite a commodity, it's a little betwixt and between, and so it becomes speculative, and that's how we have these, wild 1,000-point swings over the course of a week.
Yeah, it's been fascinating just to watch it. In this month, we've seen it swing from 8,000 down to 5,600, back up to 8,000, and I'm always trying to search and understand why this thing has exploded the way it has, and who would be using it. Recently, we had on BMO's Jack Ablin, who's the CIO over at the private bank, and he stated that Bitcoin may have benefited from the demonetization that occurred in India last year and the Syrian refugee situation. And it's certainly, when you see companies like Square adopting it, it really adds to the credibility, I think, of the underlying security. If you can use that word, I'm sorry, it's not a security, it's whatever it is.
Right. I'm not sure what we should call it other than cybercurrency.
Right.
What was interesting was the shift in China. They basically put a kibosh on a lot of the local trading because I surmise the Chinese had figured out that locals were using Bitcoin to ferry cash out of China as a way to create a little bit of a life raft if you decide you want to escape. It's still a centrally planned economy, and you never know when there's going to be the next bit of overreach from that government. But it raises a really interesting question in terms of how far beyond the reach of governments are things like Bitcoin, and does that mean we're going to, it's not Silk Road selling drugs over the internet, it's anonymous transfers of large amounts of capital. And that potentially raises some questions, not just with black market things, but what happens the first time somebody buys an assassination for $50,000 in Bitcoins online? And those are the sort of, dark reaches of the underside of the internet that is going to cause, because I can't help but maybe I've read too much William Gibson when I was younger, but it seems like that's something that's an eventuality, and that will draw a lot of government scrutiny and a lot of government oppression on that. Although at this point, I don't know if there's anything anybody could do to stop Bitcoin, and so it has not only its own momentum, but it's really created its own community around it.
Mm-hmm. Yeah, I think as long as people continue to adopt it, that's its power, right? And that goes for any currency, right? The medium of exchange. If you agree that that's what it's worth and you exchange it, you can buy goods and services, whatever those are, then that's the game. And that's what makes it, all those reasons that you laid out make it really fascinating, and you paint this dystopian future where you're going to get some bad things happening with it. I'm not sure, but
as well as good things, right?
Yeah, as well as good things, right? And you think about the Syrian refugees. Like, I mean, if there's upheaval and you're not sure you're going to be able to get a bank to agree, or your bank is in Syria and you got to get the money over to someplace else, there's all sorts of interesting things which it really helps with. But I'm just fascinated to see Square use it, because that's the first one that I've seen that I'm aware of, and I'm sure there's some others, but a big one for payments. And that's really, I think that gets at the heart of what you were talking about with DLT in the use of that technology.
So think about this for a second. Pull a $20 bill out of your wallet, and we can have a philosophical discussion of, is the value of that green piece of paper a collective societal delusion, or does it reflect the overall faith in the government that stands behind it?
Right.
And, or is it a little bit of both? Are they related? And so what makes Bitcoin so fascinating is, on the one hand, it's as much a collective delusion as any other currency or not. At least when you're looking at gold, there is some inherent value in a shiny yellow metal that's used for jewelry
as well. There's scarcity as well, right, with gold.
And there's scarcity with Bitcoin, which there isn't with dollars or euros. And here's the key differentiator that's so fascinating. You don't have to have a faith in the Weimar Republic or Brussels or the United States.
Venezuela.
And I'm not a truther. I'm not a prepper. I always tell people, if you think the dollar's going to zero, mail me all of your worthless U.S. currency for proper disposal. I'm happy to take it off your hands. So I'm not one of those guys that think, oh no, we need bottled water, a 45, and meals ready to eat along with our gold. I'm very happy with dollar bills. That said, instead of putting your faith in a government, you're putting your faith in the underlying technology of the blockchain. And there are elements of a little bit of religious zealotry there. There's a mysterious founder who issued a decree very early on, and there are the founding papers, and there's a lot of mystery surrounding it. So this, I don't know, is this a currency? Is this a belief system? Is it a spiritual or religious belief? It's all of those and none of those, and it's going to be fascinating to see how this develops over the years. I'm especially intrigued at how large banks and financial institutions can use blockchain to reduce or eliminate fraud, and I think that's a really interesting area.
Yeah, for sure. And there are literally billions of dollars being sent into
tens
the
of billions.
Tens of billions, right. I mean, it's incredible. Like every conference I've gone to, there are sections on DLT, and you're trying to figure out if it's a private blockchain or if it's public. And I mean, there's just some really interesting things going on in that space. Well, let me just switch gears a little bit to something else in fintech that I know that you're very familiar with, and something that's developed. And I wanted to get your thoughts on this, and that is the robo-investing or robo-advisors that use algorithms to make investment decisions for clients. You're in this space, Barry. Do you see this like as a challenge for the investing community, or do you incorporate them into your investment decision making? I would assume, I think that's kind of a silly question because everyone to some extent should be using an algorithm to, be more efficient in their investing ideas. But what do you think about this?
So there's a bunch of really, again, another fascinating technology that is, it's being implemented in ways that are kind of fascinating. We set up a robo-advisor almost 3 years ago because we frequently found ourselves with small portfolios and small clients. They did not require the full suite of services. There was no estate or tax issues. There was no generational wealth planning. All these different things that you pay an advisor a fee for were not necessary, and this was a way to offer a good portfolio at a low cost with a fairly light touch, meaning if you don't need a quarterly review, if you don't need an annual, here's how our financial situation has changed, you pay for that when you're paying 75 to 100 basis points to an advisor. But if you don't need it, you're better off paying 30 or 40 basis points and letting the technology manage that for you. Now, that said, there are a couple of issues that we run into with the robo-advisors. Most prominently, the fact that robo-advisors, as we know them today, have pretty much existed only during a rampaging bull market. Like, you feel pretty smart when your fees are low and you throw money at stuff and it just goes up. And I think the challenge for the robo-advisors is going to come the next market crash. And notice I'm not asking if there's ever a market crash again, because history has taught us there will be another recession one day. There will be another market correction. One day volatility will return. One day interest rates will be higher. And one day we'll be looking at another 25, 30, 35, 40% market correction, or maybe even an 08, 09 or 73, 74 market where we're cut in half and then some, about 57%. So it's easy to just keep making automatic payments and average dollar cost average each month when the markets just go up and up and up. I think and I mentioned this earlier in our conversation, the behavioral side is so important for individuals. Most people underperform their own portfolios, which sounds ridiculous, but it's true. There's a tendency for people to chase the hot manager and buy into a fund after it's had a run up, and we've also just look at March 09 to see how people capitulated and finally just puked everything up at the bottom. And so the question for the robo-advisors are going to be, how well are you going to be able to manage your client's behavior during a significant downturn? Now, we've seen some signs from a handful of companies, Vanguard and Dimensional Funds in particular, that during 08, 09, their clients, for the most part, rode out the downturn, and now they're reaping the benefits from it. Some of that has to do with the concept of passive investing. Hey, I can't time the market, say most people who are Vanguard participants, and therefore I'm just going to let it ride. or with dimensional funds, which really implements the famous French factor models, which in English means we know over long periods of time value beats growth, small cap beats large cap, high quality beats low quality, and therefore we're going to tilt our portfolios in that direction. Their clients also were pretty steady throughout the downturn and did not panic.
Right.
But that's a philosophical difference. And the $31 trillion question is, what happens during the next downturn on the robo-advisors? I am fond of saying that half of the value that RIAs and other such advisors provide is being a steady voice of reason and rationality and talking their clients off the ledge when they want to do something silly,
right,
out of either panic or emotion or what have you. And, all you need to do is not sell out in March 2009, and here we are, the S&P bottomed at 666. Hey, guess what? We've tripled since then, and then some. That covers a lot of 75 basis point advisor fees, probably a century's worth. So, and I think that not every advisor does that the same way, and not every robo-advisor client is going to panic out. But when we see the next major correction, that will really be the key to whether robo-advisors are just going to be a tool that everybody can use to some small degree, or if they're going to attract a significant amount of assets. By the way, Wealthfront, Personal Capital, Betterment, all these firms that have $3, $5, $7 billion. It's been barely a year and change since Vanguard announced their robo-advisor, and they're up to $100 billion.
Wow.
So the universe of robo-advisors is Vanguard, and then everybody else is almost a footnote, and there's some irony in there.
Well, let's talk about Vanguard for a second, because
sure.
And when we had spoken on the phone earlier, we were talking about ETFs and the low volatility environment. I just want to ask you again, what do you think is the connection here?
So I'm gonna make a really long story really short.
Okay.
The history. Now, understand, the way most people have been investors in Wall Street, for the longest time, it was not democratized. It was only the wealthy participating in Wall Street, unless there was some crazy boom, and then the joke was the shoe shine boy on the corner was giving Kennedy tips, and that's how he knew. This is all but over.
Yeah,
but in actual dollars, the vast majority for the first 3/4 of the century of the 20th century was primarily wealthy. We've seen a democratization of that. Credit Merrill Lynch and others and the Thundering Herd, and remember the commercials from 50 years ago, Merrill Lynch is bullish in America. That really brought a lot of people into the markets. Mm-hmm. You had the IRA rules and the 401k plans as people moved away from pensions that were defined pensions, and they became 401ks. So lots of people started participating in the market. And then you ran into some trouble in the late 90s. You had the dot-com collapse and the accounting scandals and the analyst scandals. And then we had the run-up in housing, and that collapsed. And then we had the 2008-09 financial crisis, and then commodities collapsed. I think that 15-year arc from the late 90s to the early mid-2000s, 2010s, a lot of Main Street people said, you know what, I'm just going to take my ball and go home. And I don't want to watch financial television, and I don't want to pick stocks, and I don't want to market
I don't want to trade, right?
I don't want to do any of this, right? Tell you what, these guys in Valley Forge, Pennsylvania, called Vanguard, I think it's technically Malvern, Pennsylvania. The idea of Jack Bogle's folly, which is what it was originally called, of let me not pick stocks, let me not guess, let me just buy the whole market and leave it alone for 20, 30, 40 years. That seems to make more sense than me trying to guess whether Apple or Amazon is the best stock to own, and me constantly getting scared out of the market and paying big commissions. And so when you move to that model of I'm going to passively invest, I'm going to put a similar amount of money into the market every month, I'm going to automate it, I'm not even going to look at it. Once a year I'll look at my statement and, okay, I'm doing okay. That approach is very, very different than what came before. And I kind of get the sense that we collectively in finance have exhausted the Main Street investor, and they said, I'm done with this. I'm just going to set it on autopilot and be done with it. Mm-hmm. And what that ends up doing is really putting a dampener on the crazy fluctuations, the volatility. Now, step back and look at the big brokerage firms, UBS, Morgan Stanley, Merrill Lynch. They used to be 90% transactional, and maybe 10% of their revenues on the investment side were coming from fee-based, meaning here's $1 million, charge me 1%, and you have discretion. You're not getting paid. You're not incentivized to be transactional. You're incentivized to keep costs low and have the money grow. That business model has now shifted, and it's about half of the asset management business at the big brokerage firms are on a similar, what I would call RIA, Registered Investment Advisor model, which is give me your money, I'm going to charge you a fee, we'll run it, once a quarter, and our job is to do as little as possible, keep you invested, and explain to you what's going on, but have you in a portfolio that lets you sleep at night and continues to gain ground over time. Now think about it, you have 15,000 advisors at Merrill Lynch, you have 12,000 advisors at Morgan Stanley. Maybe those numbers have even gone up a little bit. When you look at that, you end up with a very different situation for a big part of what was once a source of that volatility. And so the idea of that regular dollar cost averaging, money going into 401ks every 2 weeks, money going in on a monthly basis, it creates a steady bid beneath the market. My partner Josh Brown calls that the relentless bid. Mm-hmm. And at a certain point, perhaps people will get frightened and that will change. But we really haven't seen that in great numbers. And I suspect that this is going to continue for a long time because this is now a secular change in the way a lot of Americans invest in equities, and it looks like it has some staying power.
That's interesting. And I wonder, just quickly, adding on to that, what about the declining number of shares in this market as well, in the public market? And that with the ETFs, it seems has also contributed to stability and prices going up. I don't know what your thoughts are there.
That's a very fascinating question. Some people have blamed it on increased regulation, although we see similar things around the world, so it's not just the United States. The joke is the Wilshire 5000 is about 3,500 stocks, right? But no one wants to change the name. At least the S&P 500 and the Russell 2000 are both 500 and 2,000 respectively. Yeah. So some of it has to do with the huge amount of capital that's available. Think about the number of private, what people call unicorns, pre-IPO companies worth well over $1 billion each. There's so much money sloshing around. There's so much capital in Silicon Valley, in Boston, in New York, or in the finance centers in the United States that it used to be imperative to go public in order to raise some capital. That's not necessary anymore. And when you look at the giant tech companies, be it Google or Apple or Facebook or what have you, they're also doing all sorts of acquisitions in ways that we didn't necessarily see in the 90s. Back in the 90s, certainly for the beginning of the decade, it was Microsoft and everybody else. And you didn't have that same sort of ramp where you could come out with a good idea, set up a company, and either go public or get purchased until it looked like Microsoft's grip was broken. And I don't even think the antitrust case had to go to fruition. the fear of antitrust forced Microsoft to allow more competition to take place. And we had this Cambrian explosion of startup companies. By the way, a quick reminder for anyone who's younger and may not remember, Apple was on the verge of death when Microsoft saved them with a deal and a capital injection, and it was really a rescue plan.
I don't even remember that. That's interesting.
Everybody forgets that. There was a famous cover of Wired magazine that had the Apple logo with the crown of thorns on it, and the cover it said one word, and it said pray, because the fear was Apple was going under. Now, to Microsoft, if Microsoft loses the only legitimate operating system competitor to Windows, they would have really looked like a monopolist.
Ooh.
And so Microsoft saved Apple, and Apple basically came back a decade later and ate their lunch. Whether it's the tablet or, by the way, Microsoft is doing just fine today. However, Apple has become the most profitable company in the world, and they have Bill Gates to thank for it, which is a little bit of irony.
That's
now,
fascinating.
the universe is so much different today.
Yeah.
It's so much more competitive. There are so many companies out there, but the need to go public just isn't there.
Yeah, I mean, and that was the whole goal of the 1990s. You know, develop an internet company, put the name internet somewhere in your name, and it blew up. But I think now what's interesting is what you pointed out is that the actual structure or liquidity under the market, as far as the number of shares that are out there, has shrunk because there's less need for these companies to go public because they're getting access to the capital. And that used to be the reason why you went public, right? I mean, correct me if I'm wrong here, but it was to gain access to capital so that you could grow through stock issuance. And now it just doesn't seem to be the case that you need to have that anymore. Or you need to have it in the extent of what it was in the 90s.
It is that, and you also wanted to be able to take your early investors out, allow your employees to cash out a little bit, et cetera, et cetera.
Yeah, and so I mean, it's just a different game right now. All right, one last question before I let you go. And because you just churn and eat up so much information, I got to ask you, what do you see are the major themes developing for the markets in 2018? Or what are you keeping your eye on, Barry?
Well, there's a lot of things, one of which is clearly what's taking place with wages, inflation, and the Fed. We've been waiting to see when we start to see wage pressure going higher. The good news is that's good for retail sales. It's ultimately good for profits. It extends the economic cycle, or at least moves it to a more normal basis. We've seen some interesting signs of that, but not many. On the low end, we've seen companies like Target and Walmart raise their basic models. Perhaps the most interesting news we've seen has been the millennials moving out of their parents' basement, getting married, moving in together, and buying houses. That's go back 5 years, and we were at record levels of what was it, something like 32 or 36% of millennials were living at home. Now, according to, I believe it was Zillow, put out a report that said the millennial generation is now the biggest pool of home buyers that are out there. So that's a huge positive, and in a normal cycle, and I can't say this is a normal cycle, but home buying is a key component of consumer spending. You buy a house, you buy some furniture, some appliances, you add an SUV. All those things drive the economy forward on a long basis. It's not a short-term fix. It's, this impacts a whole swath of companies for years to come. And we're starting to see signs that that's upticking. That could be the most bullish thing I've seen in the past year.
Wow. All right, CIO and Chairman of Ridholtz Wealth Management, Barry Ridholtz, thanks for coming on the show today.
Thanks so much for having me.
Remember, if you want to hear more podcasts, you can go to our website, cftc.gov, and click on the podcast button. Or you can find us on iTunes by searching for CFTC Talks on your podcast app. We'll be back next week with another guest on our quest to learn about the markets we watch. I'm Andy Bush. Thanks for listening. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guest. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.